Today's market call is presented by FactSet, financial data and analytics powered by Tomorrow, and SoFi. Get your money right, all in one app.
And the band played on this December 11th, 1 o'clock on the East Coast. Elizabeth Young-Thomas sitting next to Dan Nathan Swizzle here from Parts Unknown. Elizabeth, how are you?
I am very well. How are you?
A little hot stove baseball. The Brewers haven't made any moves, but they're probably just laying in the weeds, waiting to see how things shake out.
We don't have $765 million, I'm pretty sure.
Either did the Yankees. Either did the Yankees. Guy, how you doing over there? You're all knotted up, which means you're coming into the city.
Means I'm coming into New York City on this rainy Wednesday. But it is a day that we have a tame, I guess, CPI in terms of what expectations were. We'll see what CPI is tomorrow, like PPI is tomorrow. It's interesting, though, that yields today are actually slightly higher as the TLT is lower. We'll discuss that. But, all is well here in Morristown, New Jersey, despite the rain, the much needed rain, I might add.
No doubt. It was a very dry August through November.
Yeah,
it was definitely. So we got a lot to do here. We have obviously Butters if it's Wednesday. And then Liz Young. We've been kind of all over the socials with this one. Liz's 2025 outlook is dropping tomorrow. Where can we find that, Liz? On the SoFi investing blog?
I'm going to put it everywhere.
Yeah.
I'm going to put it on lampposts.
We're gonna share that thing, but we're really excited to hear the high level that you're thinking there, and we'll revisit those some of those main themes, Guy, won't we, throughout the next couple of months?
Are you kidding me? Of course we will. This is excellent reading. You should all have it in your inbox, and we will, of course, put up a full slide to find so you can find it exactly where and what to do. But with that said, this lower left, upper right in terms of the S&P 500 continues. You have a NASDAQ that breached 20,000. I believe, Dan, you know this better than I, but for the first time in its history, which is all these milestones that the market's been looking for. Even the Russell participating a bit today. So seemingly on the back of this data this morning, people feeling pretty good about things.
Yeah, and I guess, Liz, maybe the question is for you here. Rates coming down. Look at the NASDAQ outperformance in the S&P 500. The NASDAQ versus the NDX, which we know is very concentrated to those top 7 names or so. Look at this thing, outperformance 33.5% year to date versus the NASDAQ 100 that's up 29.5 or so. The NASDAQ composite is up 27.5% from its August 5th lows. Now we know obviously that look at that, Amanda just getting all up in there. So why is it today just the expectations, the CME Fed funds, Fed watch tool, we above 85% for a 25 basis point cut?
In the 90s,
so we see that the Mag 7 is raging. Like help us figure this out.
Well, since we started by talking about yields, I just want to point out there was a 10-year auction that just came across the wire.
Nice.
It hit at 423. So you saw this drop, as Guy was saying, that from
423 in the 10-year.
Yep. So that's where there's this drop that happened right at that moment from 425 to 423. Okay, so CPI came in bang on expectations, which is kind of a snore, right? Month over month at 0.3%, year over year at 2.7%. And then if you break it down further, this is on my Twitter. If you want to go check out the charts, I know all of you do. If you break it down further, what people tend to be worried about is super core CPI, which is services X shelter. I keep making jokes. If we strip everything out, that's a problem. Of course, it looks fine. So super core, though, still tends to be pretty sticky. People are concerned about super core. Well, if you take out car insurance, it looks much better. So there are still these two components of shelter and car insurance that continue to be problematic. If those slowly come down over time and we stay on this trajectory, CPI should continue relaxing. So we know we're still a little bit above target. Actually, PCE, core PCE is pretty much right at target, so not as worried about that. But in any event, I'm not going to try to make news where there is none. CPI was pretty boring today. So you saw a drop in the yields right at the report, and you saw actually the Fed funds rate cut expectations go up to 100% for a whisker of a minute. And
whisker or whisper?
Either.
Yeah.
Small
Guy, you want to weigh
portion
in here for a second? Whisker.
It's interesting. I think people struggle with that. I mean, I think in that context, Elizabeth is right. I think it is a whisper, but
I said whisker. I like
or whisker.
What you know what I mean?
Sorry, I'm sorry.
There's
So
no
it's
question about the
within
meaning.
it's within something of
Yeah.
what?
A small percent, like a very small minute, it went up to 100%. Now we're back down to 94%.
Wow.
Odds of a cut, 94.7% actually.
So-
odds of a cut in December. So we're getting 25 basis points next Wednesday.
So, guys,
basically.
question for you, and Amanda's going to throw up the 10-year yield with where the 150 is. So 25 basis point near certainty cut, right? Is this the sort of thing that could spark this sort of rally in the NASDAQ in particular? It just seems very odd to me. And, I'm sure you're going to look at this chart and you're say it held support.
Mm-hmm.
It looks like it wants to rage back towards that 450 level. I don't know.
Listen, that's what I think. And, I understand the prognosticators out there, and obviously the betting market suggests it's a near certainty. That makes sense. And given some of the rhetoric we've heard from the Fed, it makes sense as well. I'm hard pressed to figure out a circumstance where they'd sort of back off. But, with that said, and Elizabeth can opine on this, core CPI has been north of 3% or greater now, I think for 43 straight months, which is the longest we've seen, I want to say, since the early 90s or thereabouts. So there's that. So I don't really get the real pressing need. And to your point, this looks pretty interesting. Now, if you throw a TLT chart up, which is obviously the inverse of this, I'll say it again. I think we're going to visit the levels that we saw in October of last year. And if you go farther out, you'll see exactly what I'm talking about. So there, you see that low right there. Amanda can sort of put the cursor down there and look. I think it was like 82 and change, which, at the time got us around 5% or so in the 10-year yields. And, I do think that's where we're headed. The first stop, I think, is logically the August low, which was probably 86 and a half, 87, 88. There you go. And now, so here we are. I mean, that's what it looks like to this eye.
Yeah, the one thing I'll just say is that, I'm looking at, Amanda, can you throw up the Mag 7? You kind of sorted these by, performance on the year. To see this sort of performance into year end, and I know that we have like almost 3 weeks, 2.5 weeks or something like that. It just seems like this is one hell of a final push. And just when you see, the NASDAQ up, let's say 30% or the NASDAQ 100, but then this sort of performance, that kind of tells you that there's a bunch of stocks in the NASDAQ that aren't particularly acting that well. Is that fair to say? Because those 7 stocks make up 50% of the NASDAQ 100, and look at the massive outperformance. Other than Microsoft, they're either in line or maybe double, tripled, or quadrupled, the performance of the NASDAQ. So, Liz, does this concern you going into year end that the major theme into 2024 seems to be the major theme going into 2025?
Well, so I think there's a couple things going on here, and another chart on my Twitter. Mario has been on it this week. So this is a chart that we posted yesterday. If you just look at factors across the market, we've had a pretty big reversal so far in December. So momentum, which led January through November, has been the worst performing factor. So basically you've had wow, you guys are fast. You've had this complete reversal, right? So momentum was the best then. It's been the worst in the beginning of December. Go all the way to the right-hand side. Liquidity has been the best performing, still negative a little bit, but the best performing, whereas it was very lackluster for January through November. So I think what's happening right now, and this goes for individual stocks as well, the ones that had not kept up, the ones that had been sort of ignored for the last few months are now picking back up. There's another chart, and let's test your speed on this one. We just posted it today. It's about seasonality and what happens in December. So actually right now, returns are tracking normal seasonality. You usually have this pullback through this week, and then you get this push into the finish of the year. So you can see here what we would expect if seasonality holds. That dark blue line is 2024. If seasonality holds, which is the shaded region, we should expect an uptick after this week in performance to push through the end of the year. So if it's the stuff that is going on right now, I think that probably holds as well. I don't think that suggests that same theme will be what happens in January and February.
And we're seeing it. Look, I mean, just you want to pick a chart, as they say. Throw a Netflix chart up today, Dan, and we'll take a look at that. And, we can go down the list. I mean, Facebook continues to sort of rage. Obviously, we talked about Google yesterday with this quantum computing. I mean, they're all seemingly, on autopilot to the upside. And, it's wonderful when you're long these things. But for a lot of these names that were just mentioned, this just continues to be a function of multiple expansion and nothing else. And that's true, by the way, with the S&P 500 as well. And there'll be people that will write about and talk about it. I'm sure Doug Cass is watching right now and say that Buffett indicator is probably approaching 208% or thereabouts, which we have never seen historically. And there are other things as well that are flashing red that the market seemingly doesn't want to acknowledge or look at right now. And valuations don't matter until they do, Liz.
Yeah, I have a question about the Buffett indicator. So, and this is for either of you because I can't opine on the individual stock. Do you buy Berkshire? Because based on the Buffett indicator. So the Buffett indicator is telling him, right, things are overvalued. We know that he has a record amount of cash right now. Does that make Berkshire a buy?
Yeah, I think that's right. And I think the stock has probably acted in kind, although there's obviously some underperformers in his portfolio. I mean, this has basically been this lower left, upper right. And I think you're right to say that, wait a second, if you want to play the Buffett indicator, you're doing it vis-a-vis the Berkshire Hathaway stock. And, maybe we trade back down to the 150-day, which we've seen before. We saw it in August. We saw it again basically in early November. But you're right to suggest that this might be the best way to play it, or the volatility index, but for that matter.
Yeah, it's interesting though that as rates went higher, this stock, and they were accumulating all that cash, you know what I mean, is a better trade, right? And so as rates go lower, they're going to be sitting on a lot of cash that's not yielding a whole heck of a lot, and there's going to be a lot of pressure to kind of get in and buy some stuff. The other thing is, there's going to be a day where he just, probably steps down, right, and kind of passes the baton, and it'll be interesting to see what the market reaction to that. He's just been, such an important part of market sentiment for over 60 years or something like that, probably 50 years legitimately. And so at some point, I mean, it's going to be very interesting to see. That being said, I remember talking about the same thing 10 years ago, you know what I mean? And he's still crushing it. Let's go back to Apple, because obviously he was selling a lot of the Apple this year, raising a lot of cash. So Guy, to your point about multiple expansion. So Doug and I were emailing about this earlier today. I can't find a better example where a stock is rallying, not really on fundamentals, but on the idea that this is a safe place to be. And the multiple, when it got from 27 to 29 to 31, people are coming up with different reasons why it deserves that, despite the really slow growth. iPhones make up 50% of the sales, and they're literally expected to grow 1%. And this, with all the narrative about Apple Intelligence, and it's going to cause this upgrade super cycle and the like. So the stock's rallied 13 or so percent in the last month. It's up 30% since, if you want to kind of circle that June 10th, that 2-day move of 10% when they announced Apple Intelligence. So the stock's trading at 34 times right now. That is the highest multiple it's traded in the last 10 years. And the growth is probably one of the lowest periods that it's been in, you know what I mean, for a very long time. Guy, what do you say about Apple all the time?
Well, it's the product of passive investing. I think there are 410 ETFs, I think, that Apple is one of the top 15 holdings. So, it's one of these names that I get it in a benign environment. It sort of wins to this. It's just sort of the beneficiary of money flows. But at a certain point, things do happen. And if you build a longer term chart, Dan, we've talked about this dozens and dozens of times. I mean, there probably been 8 or 9 times over the last 5 or 6 years that you've seen, 25 to 40% downdrafts in this stock from an all-time high at the time. And, I think it's just, be honest with you, I think it's just a matter of time before we see it again. I mean, we saw it to a certain extent on that August 5th move, that move from July into August. Then obviously we've seen the entire thing gotten back and built upon. But, again, it's just, I think it's almost a foregone conclusion that we're at the precipice of another one of those types of moves.
Yeah. And you can make the argument that the real story is maybe not as much about the hardware, right? That's the installed base. It's kind of like the kind of the printer and the ink sort of model. So the idea, if you can kind of make a fundamental argument, is that you're going to see multiple expansion based on the higher percentage of their revenue that's going to come from services, and Apple Intelligence, while it's still really early right now, is going to spur a bunch of that. So I get it. I could see, 44% margins going to 48%. I think they're expected to be like 46.5. And so you tell me what every margin point that this company gains, you know what I mean, through that kind of mix shift changing, what does that mean to the multiple? I can see that math. I mean, but I just don't see buying the stock on a runaway breakout right here is a great way to do it. Liz, I just want to get your sense from a sentiment standpoint. Let's pull up Alphabet. This would be the Google. It was underperforming. You saw how much it sold off from those highs in July. I'm not asking you to opine specifically on the stock. You get a headline. So you have FTC pressure to kind of break the company up. You have the all these companies like Perplexity kind of nipping at the heels of their search business and the like here. And then all of a sudden they announce some like breakthrough in this quantum computing, and the stock goes up, 10% in a straight line over 2 days. It makes a new, all-time high here. When you see that sort of price action, going back to what you said about the seasonality, does that just seem like a chase? You know what I'm saying? Like folks saying, let's rip this thing at a year end. It doesn't matter on fundamentals. We'll just find any old excuse to do so.
Well, I think the smaller growth that was happening before this big jump up, before the gap, right? There was a climb that was already occurring. I think that is the momentum that was going on in the market post-election and into the end of the year. This market, though, first of all, is tech obsessed. And I'm not saying that's a bad thing, but tech obsessed. You can't necessarily argue that a jump like this is due to just environmental factors. They did make an announcement. Mm-hmm. So the tech obsession will reward, I think, new innovations, will reward announcements like that, just because that's what we've been used to as driving returns over the last 2 years. So I don't think that this is necessarily out of character for what investors have been rewarding over time. And breakthroughs, of course, are going to get rewarded in a tech-obsessed environment. But you do have to be careful here. And one of the risks, and I know we're going to get to the outlook, but one of the major risks that I outline is that speculation becomes overdone. And to be fair, there are more pillars of strength right now than there are risks happening in actual data. But this is a speculative market. It's become more and more speculative into the end of the year. I would expect that to likely continue. Speculation in and of itself does not make it a bad thing, but many of the big crashes are caused by over speculation, over risk taking, and things like Guy mentioned before, which is pure multiple expansion, much more than fundamentals.
Yeah, and this, by the way, Dan, JM460 had a question about Google. Timmy or Amanda can throw it up. So I think we addressed the question he asked. Was it Google News that great, or is it a market overreaction? So, I think we're addressing it. I do think, but again, I think we would agree that out of all those Mag 7 names, Google is one, at least valuation-wise, Dan, you could still sort of wrap your head around. You throw Facebook in that mix as well. Some of the others, not so much. But a move of this magnitude, to me, is something you definitely want to take with a bit of a grain of salt.
Yeah, I mean, listen, this is a company that's amazingly innovative. It goes by Alphabet now, not Google. Why does it go by Alphabet? Because they are doing all these things away from just their search business, right? Which they absolutely own. And so I think a lot of investors have gotten very focused on, what the regulation might be, right? To break up that company so they don't have the stranglehold, on digital advertising and search. But then also, Guy and I just had a webinar yesterday. You can find it on the Risk Reversal Media YouTube page. We had the chief business officer of Perplexity. We had the CTO of FactSet. We were talking about how these companies are basically integrating, that generative AI capabilities within a company like FactSet. We mentioned this all the time. This is one of the first use cases that Guy and I have seen that really works, for a company that is basically has all the data. They have this customers. They have customers who want increased productivity. This tech integrated into what they do is perfect. But on the flip side of that, we've seen a lot of companies who have not been able to demonstrate the return on investment. They will get it. It just depends when. And so I guess the case, Guy, that you and I keep making is like, is the stocks running ahead of this? Is it pulling forward performance? Might the productivity gains that they get be more muted than the stock prices or performance expect? And I think that's the thing that plays out into 2025. So when you see an Alphabet basically get some gain by something that nobody was looking at, I mean, I think that's the main point. Well, that's fantastic. We've been talking about Waymo. This is a division of Alphabet. This is an amazing service, whether it's going to be crazy competitive, whether they're going to be the leader, whether there's enough, there's enough TAM for about multiple winners. I think you could go look at Uber and Lyft and you could say it was winner take all. I mean, think about that, right? So it might be winner take all if Tesla ever gets their act together in robotaxis, and maybe that's a failure for Google. So I don't know. I know I'm a little hopped up about some of this stuff because when I see a move like this, yeah, you could be right on the fundamentals and the stock could go there. You know that expression, both things can be right. Well, I think that's what we're seeing in a lot of popular stories, Guy, right now in the market.
I like when you get hopped up. By the way, JM460 was saying Apple buybacks maybe. I don't know what Apple's always buying back stocks seemingly, so that might be part of it. We'll see. This is for you though, Elizabeth, because this is a good question from Gary Webb. Do you really believe that the Fed is currently restrictive? And, I think I know what the answer to that is. I'm curious what your thoughts are, because you probably have the data that can answer this.
Well, there's a lot of different ways to answer that question. Some people use the rule of if the Fed funds rate is above the 10-year, and right now it is above the 10-year. Technically, the upper bound is. If we get a cut, we'll start to get right around there, and that would be maybe some very simple definitions of neutral. So if you've got a yield level that's the same as the upper bound of the Fed funds rate. You can also look at this, though, in other ways. I think what's going to happen in 2025 is that we're going to learn that the Fed has a lot of other tools besides just rates. And we know right now the expectation is we're probably only going to get 3 more cuts, or at least this is what the market thinks. We'll get 1 in December and then 2 in 2025. But we're going to find out that they have other tools that are actually effective, maybe not as effective as the Fed funds rate, but they can increase liquidity in different ways. So I think we're going to start hearing about them playing with it from different perspectives. The other thing that you can look at is obviously just financial conditions. The market itself does not seem to think the Fed is restrictive right now. That's what I would say. So, and it doesn't really matter whether or not we think it's restrictive. Is the market telling us that it's restrictive? The answer to that right now is no.
Guy, where are you? We were talking yields. And so the condition in which the 10-year might go back to 4.5, despite the fact that the Fed, let's say, is going to lower interest rates by 25 basis points. Lid just told us how much the market's pricing for 2025. Our friend Rebecca Patterson, who's been on the pod with us a bunch, comes on Fast Money. She had a great op-ed in the New York Times talking about inflation and, what it might look like next year, given all the threats from President-elect Trump with obviously some of our biggest trading partners. And she was giving some data about like vegetables and fruits and what percentage of them come from Mexico. It was like a half of the vegetables and like maybe a third of the fruit and like 90% of the avocados. And I know you're a big guacamole lady, you know what I mean? That sort of thing. Like guacamole. No, this is a great read. We'll put this in the show notes here. And so I just wonder if the enthusiasm about lower rates, about basically, lower taxes is offset by, literally by inflationary pressures reemerging here. And I know that, we had the CPI this morning, the market just doesn't seem to care right now. Guy, might it care at some point in 2025?
Yeah. I thought it was going to care in 2024, and it did for a while, then it didn't for a while. And, I'm one of these people that believe the Fed could lower rates by 50 basis points tomorrow. And I don't necessarily know that, the 10-year is going to act in kind over the next couple of days after that. I still think the trajectory is higher for a myriad of different reasons, that being one of them, and the amount of issuances coming due early in 2025 being the other. And there are people a lot smarter than I am out there, which is a low bar, but are betting against the bond market as well, like Paul Tudor Jones and Stan Druckenmiller, for some of the reasons that we've cited. So both things can be true. The Fed can be lowering rates, and rates can be going higher at the other end of the curve. Now, theoretically, that should make the yield curve steepen in a material way. But then you have to ask yourself, what's the underlying reasons why? And is it a good thing? Are you a good witch or a bad witch? And, that's the question that I think a lot of people are trying to figure out right now.
All right, let's do this right now because I think it ties in pretty well with some of the stuff that we just talked about here. So if it is Wednesday, it is John Butters. He's the senior earnings insight analyst over there at FactSet. He drops his insight report every Friday morning. Where can you find that, Jacob? There it is, factset.com/insight/subscribe if you want it to your email back Friday morning. But we get a preview of it. So let's talk a little bit about, Butters is talking about targets for the S&P 500. We certainly spent some time discussing that over the last few weeks. A lot of strategists are coming out with their, 2025 outlooks. Liz obviously certainly is. When is yours dropping tomorrow?
Tomorrow. Yeah. Usually 5:30.
5:30.
Well,
so set your alarms here, people, Eastern, because this one's going to be flying off the shelves a little bit. Guy's going to be heading down to his newspaper stand to get a copy of this. All right, let's talk about what Butters is focused on here. The bottom-up target price for the S&P 500 is 66.71, a 10% increase over the next 12 months. Analysts have overestimated the year-end closing price of the index by 7% on average over the past 20 years. And we'll do the sector level in a second here. But Liz, we talked about this last Wednesday. Butters was hitting this from not the target perspective, but from the EPS perspective. And it's pretty similar that I think he suggested that just under 7% overestimated for the EPS growth for the forward year. So what are your thoughts? You are a strategist. You don't post an outlook number, but you have a lot of experience doing this with some of your peers or looking at it from your peers. How do you think about Butters' work right here?
Well, okay. So first of all, just doing the math on this, I'm assuming this is actually 7%, not 7 percentage points. So let's say this is correct and analysts did overestimate by 7%. That would put 2025's gain at 8.9% instead of 10%. Okay. So 8.9%, still a pretty good gain, going to look really paltry compared to 2023 and 2024, but still positive. If analysts have overestimated earnings growth by 7%, not percentage points, we still have earnings growth that will outpace price growth, which means that the multiple stays at least steady, if not goes down a little bit. So none of these projections are outrageous. That's the first point I would make. Now, usually early in the year, the projections are not outrageous. And then we watch analysts chase all of the projections and move their price targets multiple times throughout the year. So I think actually the biggest surprise in 2025 would be that if this all happens again, and we've got everybody chasing their own tail to raise price targets, raise all of their earnings estimates into, let's say, the second quarter, because that's about when it really picked up steam last year. We had a lot of raises to targets in March, April timeframe. So I think this work is important to look at as we start a year, just to sort of gauge what everybody's vibes are and what everybody's expectations are. The good news about this is that the bar is a little bit lower. This is all sort of average numbers. We can get to average numbers. The bad news about this is that I think sentiment is telling us that the market doesn't go down and earnings don't go down either. And you know what? They do sometimes. So we always have to be ready for that.
No, look, I think you're spot on in terms of your assessment. It's within the norms, right? Without question. And the question one has to ask themselves on the back of that is, what could punch a hole in this? And I think it's one of two things: interest rates, which we've discussed ad nauseum, and something we haven't discussed today, but is out there, and Elizabeth has talked about it, is the potential for the unemployment rate to move up in a significant way, which I don't think is consensus, by the way, but is clearly out there, I think, if you look under the surface. So a combination, Dan, of higher rates for the wrong reasons and the unemployment rate moving significantly higher. When I say significantly higher, somewhere between 4.7 and 4.9, I think that's what could sort of punch a hole in this entire thing.
Yeah. So one of the things I love about Butters' work, and to Liz's point about, a lot of strategists kind of chasing their tails or chasing each other to kind of upgrade their outlooks as the kind of price goes up in the index, he'll continue to update that. And so to us, I think that is probably directionally most interesting to me, because it obviously speaks to sentiment and a lot of investors and strategists kind of chasing here, because if you don't see the commensurate EPS increases and you just see price target chases, then that just means, to Guy's point that he made a bit ago, you get multiple expansion, and that's the sort of thing where accidents happen in the market. Let's just, before we get out of here, let's talk about Butters' work on the sector level. The healthcare, energy, and material sectors are expected to see the largest price increases. The consumer discretionary sector is the only sector expected to see a price decrease. Now, I just want to hit the consumer discretionary for a second, Guy. If you look at the XLY and you look at the makeup of that, Tesla and Amazon are two of the largest they are the two largest holdings in that ETF, which covers the sector here. So again, I don't think those are exactly consumer discretionary. And you think about just the performance they've had of late, Tesla's gone from what, $200 to $400 in like a month and a quarter or something like that. So talk to me a little bit about how you think about consumer discretionary, because this is an epic runaway.
Well, it's epic, but based on exactly what you just said. I mean, we can quibble about whether or not these are poorly constructed or well-constructed ETFs, but I think we would all agree that the weight of those two names in this probably, it doesn't probably skew it. It skews it considerably. So the question is, right, what's next from here? The prior all-time high in this happened in November of 2021. I believe it was around 205 or so. We obviously just sort of blew through that in late September, early October. The question is, do you do a back and fill back to the prior high, which I do think we will. which then begs the question, what is it going to be? Is it going to be Tesla, a sell-off in Tesla that's going to get you there and a potential huge double top in Tesla? Or does Amazon give it back on perhaps some spend concerns there next quarter? So I don't know the answer to that, obviously, but what I'll tell you is I think a pullback to that prior high is inevitable.
Yeah. Pull up a 5-year chart really quickly before we go to the other sectors and get Liz's take here, because I think to your point, Guy, about those levels, pretty interesting stuff. So pull back to that breakout level would make some sense. That was that gap that we saw with Tesla and Amazon around earnings. All right, Liz, the other sectors, healthcare, energy, and materials. So those are the 3 largest expected increases in price.
Yeah, and actually I wrote about this in the Outlook that healthcare, industrials, and materials find themselves in new leadership positions in earnings growth for 2025. So healthcare is actually one of my contrarian ideas. I have talked about it on CNBC. It's in the Outlook. It's a contrarian idea because it's been the worst performing sector so far this year. Also because of some of the political stuff that's going on, policies that are expected to be anti-vax. And we've got this food thing going on that would affect staples as well. But just the healthcare stuff that's been in the narrative, in the news. I think a lot of it's baked in. A lot of the bad news is there. Now, I do think there's risk still in some of the pharma because of what's happened recently, where you've got these companies that are really dependent on one specific thing, right? You never want to be that concentrated. But I think healthcare in general, a lot of times, I think I used this phrase last week, if you think all the bad news is baked in, it might be time to step in, because if anything changes, you're going to have to see this repricing back up. Now, does that mean it's going to see a 25% year? Maybe not. Healthcare doesn't usually do things like that. But if you get a repricing at least to a mean reverting level because some of the bad news didn't come true, I think this is a good contrarian pick.
All right. So, Elizabeth, that's a little bit of a tease, what's dropping in terms of the note that you did and spend a lot of time on. Anything else you want to sort of give us prior to its drop, as they say, the kids say?
No, I mean, look, it's pretty positive for this next year. And part of that is, every time I have to write an outlook, I have to sit back and have a one-on-one with myself. Can I prove the bear case? Can I prove the bull case? You can usually prove both, but which one is stronger in the data at the moment? And you have to try to be intellectually honest, no matter how uncomfortable it feels. So I've had a couple years of being cautious, or at least skeptical, of the rally, and that's been wrong. The rally has absolutely raged on, and a lot of the economic data that we expected to break has not broken. And in fact, maybe it weakened for a while, but some of it has re-strengthened, and you have to respect things like sentiment. So there's a lot in it that I think is important to read through. We talk about, first of all, pillars of strength. And the big pillars of strength, starting with the liquidity spigot, which I'm talking about for in the first half of the year. There's been a lot of concern over liquidity as that being the thing that could take the market down if we lost liquidity. We know we're going to hit the debt ceiling in January 1st. We're going to hit the debt ceiling, but it sort of doesn't matter because we have the Treasury general account to support us. So we've got this extra boost of liquidity. We know that the market loves liquidity. Now, that also means that if you have liquidity going on and flowing, you probably have tech stocks that hold up decently well. So one of my calls, which will come as a surprise to absolutely nobody for 2025, is software over semiconductors, but you do have to have a presence in tech. All right. The next big part, big pillar of strength that we talk about, and I really like this one. This is actually about the labor market. Now, of course, this breaks down if our fear about unemployment going up comes true. The labor market has really low churn right now. And what I mean by that is low hires and low quits. Okay. So people are not moving around. What does it mean when people are not moving around? It means they're staying in their jobs longer. It means they are probably getting better at their jobs. We've got a productivity measure right now that is above pre-pandemic levels. If people are staying in their jobs longer, they are more productive. And that is just a fact of what's happening in the data. What also happens then is you have cooling wage pressure because people aren't moving around as much. Companies aren't as desperate to try to get new employees. So cooling wage pressure starts to lessen the blow of inflation reacceleration fears. And that's another pillar that, if it holds up through 2025, can actually allow for expanded margin growth in earnings. A couple other things I'll just cover really quick. Inflation has to stay under control. But it is sort of under control right now. That has to remain the case. And then you have to respect sentiment. I've talked about this. Even if it doesn't make sense, right? And even if the reasons for sentiment going up don't make sense, it doesn't really matter. If people feel good, they're going to spend money. And this is a shameless plug, but I recorded the next episode of my podcast yesterday with the chief marketing officer of Saks. And she talked about the luxury consumer. And one of the points that I loved that she made was they do this survey every quarter. Their shoppers spend more money when they feel better. It has very little to do with what's actually happening in their personal finances. It's all about how they're feeling about the economy. So you have to respect sentiment as a strong point here too.
Talk about that all the time, Dan. That's, that sort of mirrors some of the things I've been saying for years. As long as people feel good about things, they will spend money regardless of whether or not they should. So thanks for that little bit of a tease there, Elizabeth. Without question, we look forward to it. And I want to thank Mario, who sent me a really kind note a week and a half or 2 weeks ago. He is a gentleman. One quick question here, Dan. Compounding Capital talks about Etsy. We're looking at a bearish to bullish reversal. And I think about a week or so ago, I noticed that Elliott Management, they increased their stake in Etsy by 11%. They're up to 5 million shares. There was just a big shakeup in terms of their corporate structure, which I think the market is taking as positive. And if you look at this, I think that's exactly what's going on. You're having this sort of bearish to bullish reversal. It doesn't mean the company is fixed by any stretch, but this is one that can probably surprise some people. And they don't report until the end of February, the next earnings report. So this one looks a little interesting to me. I think that's a good question, Dan.
Yeah, I mean, listen, it's. I think people are so not interested in some of these consumer, sort of app things. It feels like Amazon is running away with everything. Shopify, another story powering lots of e-commerce thing. I mean, I'm hard pressed to kind of think about, what it looks like in 2025 when everyone's really focused on, generative AI and kind of implementing that into their current products or services. Like at some point, Etsy's going to have a really nice announcement how they're using generative AI to, interact with clients or, vendors and this and that, whatever. And it'll be interesting to see at what point of the cycle, the market kind of rewards that sort of behavior. So I don't really have much to say about Etsy as a company. I just don't think particularly interesting when you think about all of these other marketplaces that exist on much larger platforms like Amazon and Shopify. So, I see what you see technically. Maybe they can back that out. 5 years. This was a COVID darling, when a lot of folks were stuck at home, this thing was going ballistic. And look at it now. It looks like an internet stock in 2001 and 2002.
Last question before we get out of here. This is about Alibaba. It's from Mark Meissner. So an update on what we talked about. I'll tell you, Mark, flat out, I am shocked that Alibaba traded below 90. I think as we're sitting here, it's 88 and change. So label me very surprised. Dan actually said it on our Fast Money call earlier today that we've basically filled in that entire gap that was created about, 3 or 4 trading days ago. Maybe that's a good thing. I thought this was going to continue to extend. I was wrong, but I will say again, I don't think it's over. I think it's just getting started. And I think the move back to at least 100 in Alibaba, which will be a 50% retracement of that high that we saw in early October-ish, and this recent low is going to be made.
Yeah, one last thing, Guy. I'm as equally surprised as you, but I've been a bit more skeptical about the impact of the kind of waves of stimulus that we've heard from. We haven't seen, rate cuts yet. And, the things that they're trying to support, obviously it's this consumer, but this consumer, man, just look at the reaction, in the stock market to this BABA. It is cheap as chips. And so if this thing goes back and fills that entire gap from earlier in the week, right? Look at that 150-day moving average. It's 86 and change. The 200 is a little below there. Those recent lows in November, you do not want to be long this, below those levels, which is one of the reasons why when we detailed a bullish options trade, I think it was about a week and a half ago. We're looking to define our risk because of this exact sort of volatility. So that's it for that. Liz Young, we appreciate you being here. We look forward to your 2025 outlook. Do you want to give us the name of it that drops tomorrow?
It's the 2025 outlook.
No,
Guy.
Defying Gravity.
What about that, Guy? Any thoughts there? So, Guy, just to be clear, you'll figure out where that lyric or that song title came from. And we made this point on many occasions. Guy is one of the more, it's interesting that you got to see The Wizard of Oz, first run
Yeah,
in the
it was
theater.
amazing.
Back then, it was only black and white. It wasn't. They didn't have that little that
Well,
switch.
no, you're wrong, because that's
really?
what startled us all in the audience. I remember sitting next to my grandfather, and I'm like, "Oh my goodness,
Yeah.
Grandpa, that's color. What
Yeah.
happened?"
Yeah, no doubt. So that drops tomorrow, Defying Gravity. That'll be
Mhm.
fun to read, and maybe we'll kind of look at some of that stuff later this week. We also have John Butters. You know where to sign up for that Earnings Insight blog, and that drops Friday morning. So check that out, Guy. You're going to jackass it into the city as
On
it's
this
raining.
rainy day, yeah, traffic shouldn't be too bad.
Dogs out
I'll
there.
see you up at the net. Do you have an umbrella?
I do.
Guy, what do you call rain gear and everything like that? What you have a name for it? You have a little expression.
Close.
No. What do you say? You say to Melissa when we're
Oh.
walking out.
Storm Dud.
Yeah, Storm Dud. What's that
Yeah,
mean?
that's a brand of umbrella that we ran across many years ago. So if it's
Ah.
raining, I ask her if she has her Storm Dud. And
That's
she
been going
typically does. She's very well prepared.
That's been going on for 16 and a half years.
Never
Any
heard of
day the guy's at the NASDAQ and it is raining outside, that question comes from Guy, directed at Melissa Lee. And, you're a creature of habit, Guy. You're a creature.
The Spanish word for umbrella is para aguas,
Whoa.
for water.
More
Literally.
water. Look at you.
Mhm.
That seems like unusually
fact.
long. I mean, umbrella is not a short word in the English language, but like whatever patawada is, it's
Para aguas.
that seems long, doesn't it?
By the
Guy?
way, that picture of Elizabeth portraying Dorothy in The Wizard of Oz is fantastic. It's one of my faves.
Oh, do we have that? Do we
She
have
has
that?
I hope not handy.
Well, maybe Jake.
I wouldn't. No, I wouldn't
right.
share that without her.
We should get out of here. It's been 42 minutes.
Yep,
Lots of
gotta
fun.
go.
All right, see you guys. Thanks for being here. We'll be back tomorrow with Carter, Braxton, Worth. So stay tuned.